Want a lower interest rate? Do this! Welcome back to the channel. Today, we're diving into some of the best strategies to help you secure a lower mortgage interest rate. Whether you're a first-time homebuyer or looking to refinance, these tips can save you thousands, and I mean tens of thousands of dollars over the life of your loan. Seriously, even a small difference in your interest rate can add up to a huge amount of money saved over 15 or 30 years. You're going to want to pay attention to every single one of these tips because you're going to learn some stuff that most people don't even know about. So let's get started and unlock the secrets to lower mortgage rates. First things first, let's talk about your credit score. Your credit score is like your financial GPA. It tells lenders how responsible you are with borrowing money. The higher your score, the more likely you are to get approved for a loan with a favorable interest rate. Think of it like this. Lenders see someone with a high credit score as less of a risk. And when they see less risk, they're more willing to give you better terms on a loan, which translates to more money in your pocket. We're talking potentially tens of thousands of dollars over the life of your loan, just by having a good credit score. So, before you even think about applying for a mortgage, check your credit report, make sure there are no errors, and work on improving your score if it's not where it should be. Trust me, it's one of the most important things you can do to secure a lower mortgage rate. Now, this next tip is something a lot of people miss, but it's crucial. Don't just settle for the first mortgage offer you get. Shopping around for a mortgage is like shopping around for a car. You want to compare rates and terms from multiple lenders to make sure you're getting the best deal possible. Imagine going to just one car dealership and accepting their first offer without even considering other options. You could be leaving a ton of money on the table. The same goes for mortgages. Different lenders have different criteria and risk appetites, which means they might offer different rates and fees. By shopping around and comparing offers from multiple lenders, you can get a feel for what's out there and potentially snag a much lower interest rate. All right, let's talk about down payments. Now, I know coming up with a large down payment can be tough, but trust me, it can make a huge difference in your interest rate. When you put down a larger down payment, you're essentially reducing the amount of money you're borrowing from the lender. This means you're seen as a lower risk, and lenders love lower risk borrowers. Think about it like this. If you were lending money to someone, wouldn't you feel more comfortable if they had some skin in the game? The same applies to mortgage lenders. The more money you put down up front, the more confident they are in your ability to repay the loan, and the more likely they are to offer you a lower interest rate. So if you can swing it, try to put down as much as you can comfortably afford. It could save you a significant amount of money on interest over the life of your loan. Choosing the right loan term is another crucial factor in determining your interest rate. Typically, shorter loan terms, like 15-year mortgages, come with lower interest rates compared to longer-term loans like 30-year mortgages. This is because, with a shorter term, the lender is taking on less risk. They're lending you money for a shorter period of time. However, there's a trade-off. While a shorter loan term means lower interest rates and less total interest paid over the life of the loan, it also means higher monthly payments. So, it's all about finding the right balance that fits your budget and financial goals. If you can afford the higher monthly payments, a shorter loan term can be a great way to save money on interest in the long run. Now, here's a strategy you might not have heard of before: discount points. Discount points allow you to essentially buy a lower interest rate by paying a one-time fee upfront at closing. Each discount point typically costs 1% of your loan amount and can potentially lower your interest rate by 0.25%. So, for example, on a $400,000 loan, one discount point would cost $4,000, but it could potentially reduce your interest rate by 0.25%, which can add up to significant savings over time. Now, whether or not discount points are worth it depends on your individual circumstances and how long you plan on staying in your home. If you plan on staying in your home for a long time, say 10 years or more, discount points can be a great way to lock in a lower rate and save money on interest over the life of your loan. However, if you think you might move sooner than that, it might not make sense to pay for discount points, as you might not recoup the upfront cost in interest savings. So there you have it, guys. Those are some of the best strategies to help you secure a lower mortgage interest rate. Remember, getting a mortgage is a big decision, And even a small difference in your interest rate can save you a ton of money over time. By following these tips, you'll be well on your way to securing the best possible rate on your dream home. Thanks for watching. If you found these tips helpful, make sure to like, comment, and subscribe for more content on personal finance and real estate. See you in the next video.